Welcome to our deep dive into the world of building trading systems. It's exciting stuff. You're interested in going beyond just buying and selling stocks.
Yeah.
You want to actually design strategies that work. Strategies that can navigate the market effectively.
Becoming a financial architect.
I like that.
Designing blueprints for success in the markets.
Yeah. And we've got some cool blueprints to work with for this deep dive.
Absolutely.
We're looking at a presentation on something called the 7 M's of trading system development. And then also we've got some snippets of what sound like interviews with, experienced traders. So it's really cool.
It's a great mix of theory and real world, wisdom, which is like always a potent combination, a good place to start. Right?
Yeah, absolutely. So, okay, the 7 M's themselves are method, market, money, measure, monitor, mindset, and machine.
Wow. A lot of
I know, right? It's like a mouthful. And they really cover everything from the nitty-gritty of your trading strategy, the actual nuts and bolts, to the psychological aspects, like actually sticking to the plan, which, as we all know, can be super tough. But for today, let's really focus on how to make these 7 M's actionable, for you, the listener, like going beyond just understanding the concepts to actually using them.
Exactly. We want you to be able to walk away from this, deep dive feeling equipped to start building your own robust trading system, your own unique system.
Yeah, your own secret sauce. All right, well, let's jump in. Let's start with M1, method.
Okay, so this is essentially your trading strategy, the heart of your system. It's the rules that will dictate when you buy and when you sell, the when to buy and sell.
Right, it's like having a recipe for your trades.
Right.
It's that set of instructions that you follow consistently.
Your trading cookbook.
Yeah, and in our source material, they actually recommend using something called the Taekwon's AFL template as like a starting point for drafting your strategy. Now, I know that sounds a bit technical.
A little bit.
But bear with me, because this template basically breaks things down into 6 key sections, kind of like chapters in your cookbook, right?
Okay, like that.
And 2 of the most important sections that I want to focus on are signal and position score. So the signal section.
This is where it gets good.
Yeah. So this is where you actually define your buy and sell conditions. It's the specific criteria that need to be met in order for you to enter or exit a trade.
It's like setting your alarm clock right. The alarm won't go off unless a specific time is hit.
Perfect analogy. And then there's this thing called position score. And this is where things get really, really interesting. So this is a way to actually rank your potential trades based on how well they fit your overall strategy. It's like, giving each trade a score.
Like a credit score, yeah.
Yeah, a credit score based on how promising it looks.
Yeah.
So not all buy signals are created equal.
Right, exactly. And this is where so many traders miss out on a big opportunity, I think. Position score lets you prioritize the trades that have like the highest probability of success. The ones that, really align with your strategies, like strengths. Imagine you have like 5 buy signals all firing at the same time. Position score helps you pick the best of the best. Like, it's like a talent scout trying to like identify the rising stars,
It's a great analogy. It's about refining your entries, making sure you're not just jumping in on any old signal. But there's a danger here too, right? The source material talks about this thing called overfitting.
Huh?
You ever run into this?
Oh, yeah. Overfitting. That's when you like tweak your strategy so much that it works perfectly on past data, but then it completely falls apart when you try to use it in real-time trading. It's like creating a custom-tailored suit. It looks amazing on the mannequin, but it falls apart the moment you try to wear it.
Ouch. So how do we avoid this fashion disaster in our trading?
So the source material has some excellent advice here. First, keep things simple. Don't try to incorporate too many buy conditions. Keep it to like 4 or 5 max. The more complex your system is, the more likely it is to break down when you're, faced with the real market chaos.
Less is more. Okay, I got it. What else? What else can we do?
Test your strategy across a variety of different markets. Don't just cherry pick the ones that like fit your idea.
Makes sense.
This helps ensure that your system isn't reliant on like the quirks of just one specific market, right? And it can actually hold up under different conditions.
Yeah. You want a system that's adaptable, like, like a chameleon that can blend into different environments.
Exactly. And speaking of adapting, don't forget about setting what they call exactly opposite conditions for your sell signals. So essentially, your sell signals should be the mirror image of your buy signals.
Okay, so like if your buy signal is based on, like a price breakout above a certain level, your sell signal would be like a breakdown below that same level.
Yeah.
It creates symmetry, right?
Precisely. It keeps things, logically consistent and helps prevent conflicting signals.
Okay, I'm starting to see how these pieces fit together. Now, the source material also talks about point and span type conditions. Can you unpack those for us?
Sure. So a point condition is triggered at a very specific moment in time. Like when, like when a stock price crosses above a moving average, think of it like a snapshot. Like it's either true or false right at that exact moment.
Okay.
And a span condition, on the other hand, looks at a period of time, like whether a stock price has been above a certain level for, say, the past 5 days. Think of it like a video clip, showing how a condition plays out over time.
So it's about confirming that a condition has some, like, staying power, that it's not just a fleeting,
Exactly. Now, the source material actually highlights, the potential pitfalls of relying solely on either point or span conditions. Mm-hmm. So, for example, you might have a point condition, like a moving average crossover. That happens to, perfectly coincide with another indicator flashing a sell signal.
Right.
Yeah.
So you might miss a good entry because you're only looking at that.
Exactly. Or conversely, right? You might use a span condition to confirm a trend, but then you end up staying in a trade too long because you're not paying attention to other signals.
Yeah. The trend is your friend until it's not.
Right. So that's where the source material offers this, clever solution.
Okay.
Combining point and span conditions to create what they call point to span.
Okay. Tell me more. I'm intrigued.
So let's say, your point condition is that moving average crossover, right? Instead of immediately entering a trade, you add a span condition that says, only buy if the price has stayed above that crossover for 3 days.
So you're waiting for that initial signal to be confirmed.
Exactly. It's like waiting for the perfect wave to surf, right? You don't just jump on any old ripple.
Yeah, you want to make sure you're not just chasing false signals.
So you're adding a layer of robustness to your entry.
Okay.
Make sure you're not chasing those false signals. Now, this all might sound a bit overwhelming, especially for someone just starting out, right?
I can imagine. Yeah.
So the source material has a great recommendation. Start simple.
Okay.
Focus on what they call VIP conditions: volume, indicator, price. These are your core building blocks for your buy signal.
Okay, so you're breaking down your buy conditions into those three.
Exactly. Makes it much more manageable, right?
Yeah, I like it. I like it a lot.
And then for your sell conditions, start with what they call OXOC, which stands for one exactly opposite condition. So for each buy condition, you have one.
Okay.
Exactly the opposite. Right. And this keeps things, again, nice and symmetrical.
Simplicity reigns supreme. All right, so let's talk about testing. The source material is a big advocate for what they call trade simulating, which basically means incorporating real-world factors like slippage and missed trades into your backtesting.
Right, exactly. Because a strategy that looks amazing on paper might fall apart when you actually factor in things like not always getting the exact price you want.
Right.
Or missing trades because of, real-life constraints.
So you're trying to get as realistic a picture as possible of how your system would actually perform.
Exactly. And remember, one backtest result isn't enough.
Oh, really?
The source material really emphasizes the importance of multiple backtests, even using what they call out-of-sample data to confirm your findings.
Out-of-sample data. What is that?
So think of it like, like studying for a test. You wouldn't just memorize the answers to one practice test, right? You want to do multiple practice tests, to make sure that you actually understand the concepts and that you can apply them to different questions.
Okay, so it's about testing your system's robustness, making sure it can handle different market scenarios, unexpected things.
Exactly. And the source material actually provides some helpful guidelines. They recommend aiming for a minimum of 100 to 120 trades per year in your initial backtesting phase. So this gives you a large enough sample size to actually draw some meaningful conclusions.
Okay, so a decent amount of data.
Right. And they also suggest, checking for a minimum of 20 to 30 trades per condition per year. So that each part of your strategy is actually pulling its weight. You don't have any,
No slackers allowed.
Exactly.
You mentioned slippage earlier. Can you explain that a bit more? I think some of our listeners might not be familiar with, with that.
Sure. So slippage is simply the difference between the price you expect to trade at and the actual price you get filled at. Because of market movements, think of it like like trying to catch a butterfly, right?
Okay.
It rarely lands exactly where you want it to.
It's always moving.
So you're accounting for the fact that the market's constantly moving. You won't always get the perfect entry or exit.
Yeah, that's a good point. Now, with all this talk about backtesting and refining your strategy, I'm curious, where does market analysis actually fit into this whole picture?
That's a great question. And the source material actually suggests skipping detailed market analysis in the early stages of developing your system.
Really? Why is that?
So they make this really interesting point that focusing too much on market analysis early on can actually lead to bias. You might start tweaking your system to fit your preconceived notions about a particular market rather than letting the data guide you.
So it's like trying to, force a square peg into a round hole.
Exactly. You might get it to fit, but it's not going to be very elegant. You might end up with a system that's over-optimized for a specific market condition that might not last. So instead, the source material suggests focusing first on developing a really robust and adaptable method.
Like we talked about.
Exactly, like we talked about in this, first section here. And then in the later stages, tailoring that method to the specific markets you're interested in.
Makes sense. Get the foundation strong first, then worry about the decorations.
Exactly.
Okay. I think we covered a lot of ground here with M1 method.
Yep.
Any final thoughts on method before we move on to the other mess?
Yeah, just emphasize one, key point from our source material. It takes time to develop a robust trading system.
Of course, yeah.
Don't expect to become a trading wizard overnight.
It's a process.
The expert in the source material, he says, it takes at least 6 months to obtain a profitable, confident strategy.
So patience is key.
Absolutely.
And on that note, we'll wrap up part 1 of our deep dive here. But don't worry, we'll be back in part 2 to explore the remaining 6 memes, starting with M2 market.
Looking forward to it.
Me too.
So
until then, happy trading.
Happy trading.
Welcome back. It's great to be back, ready to dive into the next 6 M's of trading system development. We really laid down some groundwork in part 1, didn't we? With M1 method. That was
absolutely. Yeah, we established the core principles of building a robust strategy, but a strategy without the proper context is it's like a ship without a rudder. It's not going to get very far.
Okay, I like that. So we need to give our trading ship some direction, and we're going to do that with M2 market.
Exactly. Yeah, this M is all about understanding and analyzing the specific market conditions that you'll actually be trading in.
Now, I remember in part 1 you mentioned that the source material actually recommends holding off on detailed market analysis until later in the process. Can you elaborate on that a little bit?
Yeah, they make a really interesting point. Focusing too much on market analysis, early on, can actually lead to bias. You might start tweaking your system to fit your, preconceived notions about a particular market instead of letting the data guide you.
So it's like, you're trying to force that square peg into a round hole.
Exactly, yeah. You might get it to fit eventually, but it's not going to be a very elegant or effective solution. You might end up with a system that's over-optimized for a specific market condition that might not last. So instead, they recommend focusing first on developing a robust and adaptable method, like we talked about,
In part 1.
Yeah, in part 1, and then in the later stages, tailoring that method to the specific markets that you're interested in.
Makes sense. Get the foundation strong first, and then you can, worry about the decorations. Okay, so when you do start incorporating market analysis, what does the source material say about that? Do they have any specific guidance?
They do, yeah. They really they emphasize the importance of understanding the the underlying forces that drive a particular market. Is it a trending market where prices generally move in a sustained direction, up or down, or is it a mean reverting market where prices tend to oscillate around a central point?
So you need to know its personality.
Yeah.
Yes.
What its its personality, its typical behavior patterns.
Okay.
And they also talk about volatility. Is it a high volatility environment where prices are swinging wildly?
Yeah.
Or is it a low volatility environment where prices are more, subdued?
Yeah. This all makes a big difference in how you approach trading, right?
Yeah, absolutely. Hey, a strategy that thrives in a trending market might struggle in a choppy sideways market, and a system designed for high volatility conditions might generate too many false signals in a low volatility environment.
It's all about finding the right the right fit.
Yeah.
The right tool for the job.
And the source material stresses the need to be, to be adaptable. Market conditions can change quickly, so you need to be, prepared to adjust your approach as needed.
Yeah. Yeah. You don't want to be caught flat-footed.
Yeah.
When the market throws you a curveball.
Exactly.
So, okay, so we've got a good grasp of the market. We know what kind of, personality it has. We know what environment it's in. So now let's talk about M3, money, which in my opinion is probably the most important one.
The all-important topic of money management. This is where we shift from designing our trading ship, right,
yes,
to making sure that it's seaworthy, able to weather any storm. It's about protecting your capital, managing your risk, and maximizing your gains.
It's like having a solid budget, right?
Yeah.
Making sure you're not overspending.
And the source material gets pretty specific here, offering guidance on things like stop loss orders and position sizing.
Okay, let's break those down one by one.
Yeah.
First up, stop loss orders. What are those all about?
A stop loss order is essentially a safety net. It's an order that you place to automatically sell a stock if the price drops to a certain level. And this helps to limit your losses on a trade.
So it's like setting a limit on how much you're willing to lose on any given trade.
Exactly. And the source material actually has a really interesting quote from the expert about stop losses.
Okay.
They call them stupid but necessary.
Stupid but necessary. That's a curious statement. Why would they say that?
Yeah, I think it really highlights the tension between, wanting to let your system play out and needing to protect yourself from like catastrophic losses.
All right, because sometimes the market just does, unexpected things. No matter how good your system is, there are going to be times when it gets things wrong.
Right, exactly. A stop loss order is there to protect you from those outlier events, those black swan scenarios that can really damage your account.
It's like having insurance on your car. You hope you never need it, but you're really glad you have it when that accident happens. So, okay, in addition to stop losses, you also mentioned position sizing.
Yes. So this is all about how much money you allocate to each individual trade, right?
Right.
It's a crucial part of money management. It's ensuring that you're not, putting too many eggs in one basket. And the source material stresses the importance of tailoring your position sizing to the volatility of the market that you're trading in and the specific characteristics of your trading system. A one size fits all approach won't cut it.
Right. It's like deciding how much weight to put on a barbell. You wouldn't load up the same weight for every exercise, would you? You'd adjust the weight based on your strength and the specific muscle groups that you're targeting.
That's a great analogy. You want to find the right balance between maximizing your potential gains and minimizing your risk.
Okay, so we've got our stop loss orders in place. We've carefully considered our position sizing. So what's next on our money management checklist?
The source material also emphasizes the importance of monitoring your portfolio's overall risk exposure.
Okay.
And they introduced this concept of what they call portfolio heat.
Portfolio heat. I've never heard of that.
Yeah, think of it as a way to measure your portfolio's temperature.
Yeah.
It's basically a measure of how much your portfolio is likely to fluctuate based on the volatility of your holdings.
So if my portfolio is full of high volatility stocks, my portfolio heat is going to be higher.
Exactly. And they suggest setting limits on your portfolio heat to make sure that you're not taking on more risk than you're comfortable with. It's like setting a thermostat for your portfolio, making sure that it stays within a comfortable range.
That's a great way to think about it. So it's about managing your risk at both the individual trade level and then also at the portfolio level.
Precisely. Now, with our money management plan in place, let's move on to M4.
Measure.
All right. This is all about backtesting, right? Putting our trading system to the test, seeing how it actually performs.
Exactly. And the source material offers some really, really valuable insights here. First and foremost, they stress the importance of multiple backtests. The expert actually says one backtest result is not just insufficient, it is insidious.
Wow. Okay. Strong words. Why is relying on a single backtest so dangerous? Yeah, it can create a false sense of security. You might stumble upon like parameters that work perfectly on your historical data.
Yeah.
But that's no guarantee that they'll continue to work in the future.
Yeah. It's like thinking you've, cracked the code to winning the lottery just because you got lucky once.
Exactly. Multiple back tests help you to identify potential weaknesses in your strategy and to, avoid the trap of over-optimizing. And remember that that out-of-sample data we talked about earlier.
Right, yeah.
That's really helpful here, too.
Right. So testing your system on data it hasn't seen before, just to, see if it can hold up under different conditions, kind of like giving your student a pop quiz to make sure they're actually learning the material and not just memorizing the answers.
That's a great way to think about it. Now, let's talk about, what to measure during backtesting. The source material recommends looking at a, variety of metrics, not just your overall profit and loss.
Okay, so what else should we be, paying attention to?
They suggest looking at things like your win rate. So, like the percentage of your trades that are profitable, the average size of your winning trades versus your losing trades, and your maximum drawdown.
Maximum drawdown.
Yeah, so that's the biggest peak to trough decline your system experienced during the backtest period. It's a measure of how much you could potentially lose during a rough patch.
So it's about understanding the potential downside as well as the potential upside.
Exactly. And the source material emphasizes the importance of not just like looking at the numbers, but understanding the why behind those numbers.
Yeah.
Why did your system win or lose certain trades? Were there any, patterns or recurring themes?
So not just about crunching the numbers. It's about extracting insights from those numbers that you can then use to improve your system.
Precisely. Backtesting is it's an iterative process. You're constantly refining and improving your system based on what you learn from the data.
Okay, I'm really starting to see the power of this data-driven approach. So we've backtested our system. We've analyzed the results. We've tweaked it. We've run it through the ringer. What's next?
That brings us to M5, monitor.
Okay, so this is where we go from testing our system in the lab to actually deploying it in the real world.
Exactly. But even the most well-designed system needs to be monitored and adjusted over time. The market's constantly changing, so your system needs to be able to adapt.
It's like it's like driving a car. You don't just set the steering wheel in one direction and hope for the best. You're constantly making small adjustments to stay on course.
And the source material emphasizes that monitoring isn't just about, watching your profit and loss. It's about understanding why your system is performing the way it is and making tweaks as needed.
So it's a continuous feedback loop, right? You're learning from your system's performance and you're using that knowledge to improve its effectiveness.
Precisely. And they suggest keeping a trading journal to, track your observations and insights.
A trading journal?
Yeah. Think of it like a captain's log, right? It's where you record your thoughts, emotions, and observations about your trading, both the good and the bad.
So it's a way to become more self-aware, identify, patterns in your behavior and track your progress over time.
Exactly. It's a powerful tool for growth and self-improvement. Now, all this talk about, monitoring and adapting and keeping a journal really highlights the importance of the next MM6 mindset.
Right. So this is the mental game of trading, right?
Precisely. And the source material offers some really profound insights here. They emphasize that successful trading is just as much about, managing your emotions as it is about following a system.
Because we're all human, right? Fear and greed can easily creep into our decision making, even when we have, a carefully crafted plan.
And the expert stresses the importance of developing the discipline and emotional control necessary to stick to your system, even when the market is testing your nerves. They talk about the importance of detaching from the emotional roller coaster of, individual trades and focusing on the long-term performance of your system.
So it's about zooming out, taking that, that bigger picture perspective.
Exactly. And they offer some practical tips for, developing that winning mindset.
All right. I'm all ears.
Okay. So they recommend, having a clear trading plan and sticking to it no matter what. They suggest keeping a trading journal, as we discussed earlier, to track your progress and learn from your mistakes. And they emphasize the importance of having realistic expectations and understanding that, that losses are an inevitable part of the game.
So it's about accepting the ups and downs, learning from your mistakes and focusing on the process.
And finally, we come to M7 machine. This is where we choose the tools and technology that will, that will power our trading system.
So we're talking trading platforms, data feeds, backtesting software, all the cool gadgets that make trading possible in today's world.
Exactly. And the source material emphasizes the need to find tools that, that fit your specific trading style and strategy. What works for one trader might not work for another.
It's like choosing the right tools for a job.
Exactly.
You wouldn't use a hammer to screw in a screw, would you?
Exactly.
And they also stress the importance of staying up to date with the latest, technological advancements. The world of trading technology is constantly evolving, so it's important to stay ahead of the curve.
Absolutely.
So you're not just building a system, you're building an entire infrastructure around it to support its long-term success. Okay, well, I think we've covered a lot of ground here with the 6 remaining myths. Yeah. Any final thoughts before we wrap up part 2?
Yeah, I'd just like to emphasize one key takeaway from the source material. Building a successful trading system is it's a holistic endeavor. It's about more than just finding the right buy and sell signals. It's about it's about understanding the markets you're trading in. It's about managing your money wisely, measuring your performance, monitoring your system, cultivating a winning mindset, and leveraging the power of technology.
It's about bringing all those elements together in harmony.
Exactly.
Well, I'm feeling pretty inspired to keep refining my own trading system after this deep dive into the 7 M's.
Yeah. And in part 3, we'll delve even deeper into some of the nuances of the 7 M's, exploring some of the the more subtle but equally important concepts.
So stay tuned. We'll be right back. Welcome back to our deep dive. We've been talking about these 7 M's.
Yeah.
And I feel like we've covered a lot of ground, but I'm sure there's still more to uncover.
Yeah.
From our source material here.
Oh yeah, absolutely. There are always more, layers to peel back when it comes to, building a robust trading system. It's a journey.
It is. It is. And speaking of the journey, I've been thinking about something.
Okay.
The last part we were talking about the importance of money management.
Yeah.
And I keep coming back to that expert's quote. The one where they call stop loss orders stupid but necessary.
Yeah. That's a good one. It's provocative, isn't it?
It is.
Yeah.
It really gets to the heart of trading psychology, I think.
Right.
On the one hand, you've got this, carefully crafted system with all its, buy and sell signals, its position scoring, its back testing. You've put in all this effort to make it, as intelligent and as robust as possible.
Right. You've done your homework.
You've done your homework. And then, you slap on this seemingly crude tool, a stop loss, that just says, the price drops this much, get out, no questions asked. Mm-hmm. It can feel like you're almost undermining your own, system's intelligence.
Yeah, it's like you're admitting defeat before the battle has even,
Yeah, exactly. Like you're not trusting your system.
Right.
To do its thing.
But here's the thing. Markets are complex, right? They're dynamic systems, and they don't always behave rationally or predictably. No matter how good your system is, there are going to be times when it gets things wrong.
So the stop loss is there to protect you from those outlier events, those unexpected, market shocks that could wipe out your capital.
Right. It's a way to acknowledge that you can't predict the future with 100% certainty.
Right. And I think the expert's choice of the word stupid is quite deliberate.
Yeah. Oh, yeah.
It highlights the emotional struggle that many traders face when using stop losses.
Yeah, because it can feel like you're giving up on a trade too early.
Yeah.
Right. Like maybe the price will turn around if you just, give it a little bit more time.
Right. And sometimes it does, which is why stop losses can be so frustrating.
Absolutely. Yeah.
But I think the key takeaway here is that we can't let those individual instances, cloud our judgment.
Yeah. We got to remember that the purpose of a stop loss is not to perfectly time every market swing.
It's about protecting yourself.
Right, from those, catastrophic losses, those rare but potentially devastating events that can derail your entire, trading journey.
It's about acknowledging the inherent uncertainty of the markets.
Yeah.
And having a plan in place to manage that uncertainty.
I like that. Now, shifting gears a bit, I wanna highlight another another key takeaway from the source material, and that's the importance of continuous learning and adaptation. This expert actually says, and this is a great quote. He says, "I can start a new strategy every day, but only one or two will be implemented in a year."
Wow. So he's constantly experimenting.
Constantly experimenting.
But he's also, he's also very selective.
Right. It speaks to the iterative nature of trading system development, you know? It's not about finding that one holy grail strategy that's going to make you rich overnight.
Right.
It's about constantly exploring new ideas, testing them rigorously, and then, refining your approach based on what you've learned, your observations and your experience.
It's a journey of discovery, of constantly seeking to improve and adapt to the ever-changing dynamics of the markets. There's no finish line, is there?
Nope. And as the expert points out, this journey takes time. They say it takes at least 6 months to obtain a profitable confidence strategy.
6 months. That's a good reminder that patience is, it's not just a virtue in trading. It's essential.
Absolutely. And even when you have a strategy that you're confident in, the market is always changing. So your system needs to, it needs to evolve as well.
Right. You gotta keep up with the times.
Yeah. The expert really stresses the importance of continuously monitoring your system's performance and making adjustments as needed. They say only get into the market when your system, and the market are ready. I love that quote.
Yeah, it's about being present.
Yeah.
Being aware.
Yeah.
And being adaptable.
Right. Yeah, exactly. It's like a three-way dance between you, your system, and the market.
Okay, so we've talked about all these different aspects of building a trading system. We've gone through the 7 M's. We've really dug deep here. So what does this all mean? For the listener, for the person who's actually trying to build their own trading system.
Right. What are the key takeaways that they can apply to their own, trading journey?
Well, I think the biggest takeaway for me is to approach trading system development with a realistic mindset.
Yeah.
It's a process.
Right.
Not an event.
It's not going to happen overnight.
No. It takes time, it takes effort,
and
it takes a willingness to learn from your mistakes. So don't get discouraged, if your first strategy.
Right.
Or your second strategy. Or even your 10th strategy.
Happens to all of us.
Doesn't work out.
Yeah.
Treat each iteration, as a learning experience, as a step closer to finding what works for you.
And embrace the the power of simplicity.
Yes.
Remember those core principles we talked about, the the VIP buy conditions and the OXOC sell conditions.
Right.
Build a solid foundation before you start adding complexity.
Yeah, get those basics down first. And remember those stupid but necessary stop loss orders. Right. They're there to protect your capital from the unexpected.
Absolutely, yeah.
And then, make sure you use backtesting and simulation to really stress test your system.
Right.
Don't rely on just a single backtest result. You want to look for, consistency across different market conditions, different time frames, really put it through the ringer.
Exactly. And perhaps most importantly, cultivate that mindset of continuous learning and adaptation.
Yeah. The market is always evolving. And so should you.
Be curious, be skeptical, and always be willing to challenge your assumptions.
Never stop learning.
Never stop seeking new knowledge, refining your approach. The journey of trading system development is a lifelong pursuit.
It is. It's a marathon, not a sprint.
Yeah.
And with the insights you've gained from this deep dive,
yeah.
I really believe that you are well on your way to navigating that journey with confidence and success.
I agree. And remember, as our expert wisely reminds us, trend is your friend until it's not. First thing is knowing when to do nothing or walk away.
That's a powerful thought to carry with you, not just in trading, but in life as well.
Absolutely.
Sometimes the wisest course of action is to step back, reassess, and wait for a better opportunity.
Couldn't have said it better myself. Happy trading, everyone, and keep diving deep.
Happy trading.